Live from the Bloomberg New Economy Forum here in the Lion City, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. The equity sell-off in Wall Street spreads to Asia, investors pulling back from risky assets amid renewed concerns over AI and Fed cut uncertainty. And our interviews out of the Bloomberg New Economy Forum will be hearing from India's TCS on the opportunities they're seeing amid market and geopolitical volatility.
And I'm Annabelle Drewlers here in Taipei for Hon High Tech Day, where the big news is a partnership between OpenAI and also Foxconn. We just had OpenAI CEO Sam Altman giving an address that's just wrapped, but we do have an interview with the chairman, Young Liu, coming up just ahead. We'll be talking about this new partnership, the companies working directly together for the first time.
Asian markets slumping today on renewed concerns about an AI bubble. After a brief rally driven by NVIDIA's earnings beat quickly evaporated, stocks benchmarks in Korea and Japan are on track for the worst weekly drops in months. Bitcoin, meantime, touching $87,000, with investors in firm risk-off mode. Also weighing on markets is uncertainty over the Fed's ability to cut rates in December, after the delayed September jobs report showed more hiring than expected. Let's get perspective from Paul Meeks, Managing Director and Head of Technology Research at Freedom Capital Markets. Paul, good to have you with us. Is this a correction or is this a meltdown?
I think it's the former. I'm very bullish on a continued strength of the AI infrastructure building trade. And I was as surprised as anyone, the fact that on the heels of its quarterly results, that NVIDIA stock was marked up 5% at the open, and that ends up swinging to a loss of 3% by the close of the markets. I think it's a gross overreaction, and I think, no surprise, it's probably a pretty good buying opportunity, not for all of them, but for some select names.
Are you suggesting it's just a matter of money being taken off the table, people just preparing for Christmas?
I think there has been a rotation, and one of the things that you said in the lead-in is important. It now looks like there's only a 40% possibility that when our central bank, the Federal Reserve, meets next on December 10th, that they will lower rates. It was a foregone conclusion a month ago, now only a 40% chance. And you need to have low and falling rates to support the valuations of aggressive growth tech stocks.
Paul, perhaps it's just too much optimism. Take a look at the unemployment numbers. They're actually higher than anticipated. Perhaps, just perhaps, the U.S. economy is not as resilient as we've been thinking.
You know, the way I look at this is we haven't seen the full impact of the tariffs. So that will really be a 2026 phenomenon. And the not lion's share, but a good portion of U.S. economic growth in 25 and even in 24 has come from AI infrastructure building. And we know they're all very intertwined relationships, very cozy relationships between the likes of OpenAI and almost all of the tech majors. So where those companies go, the tech sector goes, the U.S. market goes, and even the U.S. economy goes.
You said earlier it is an opportunity to buy the dips. What would you be buying?
I actually think the kingpin of all of them, NVIDIA, is very attractive. NVIDIA is trading for 24 times next year's earnings, and they'll probably have growth of about 50%. So we call that a PEG ratio, or a PE to growth rate of about 50%. And our 24 times for NVIDIA compares very favorably to the 21 times ratio for the S&P 500. So only a couple of turns above the overall market. for much better prospects, higher profitability, higher cash flow, and a multitude of the revenue growth.
There are better valuations elsewhere, right, Paul? I mean, and perhaps the players are not just in the US. You could find those players in markets like China as well.
Oh, sure. I've been a buyer recently of Alibaba. I think it's very attractive. And of course, the most important semiconductor company in the world, of which even NVIDIA is dependent, is Taiwan Semiconductor. And Taiwan Semiconductor should have, throughout this AI revolution, and then with quantum computing coming behind it, many years of great prospects.
Paul, there seems to be too much optimism, perhaps even euphoria. What do you deem as the risks which are being underappreciated right now?
So I think the geopolitical situation, here we are kicking the can down the road again for about a year now. We do not have a very critical deal for not just tariffs, but for decisions on export controls in that agreement or potential agreement between the US and China. As I mentioned before, now we have a less clear path to lower interest rates, of which stock valuations are dependent. And you know who we have in the White House? Some people love him, some people hate him, but it brings a lot of anxiety, uncertainty, and that's typically bad for business because business leaders can't plan their next year under those conditions.
So less room for the Fed to move. What do you see the Fed doing in December? And how many cuts are you looking at from now through 2026?
Because of the lack of necessary economic data to judge things, with the former shutdown of the US government for 40 some odd days, I don't know if the Fed will be able to lower rates on December 10th because they just don't have enough to go on. So I think that they push it off, and I still expect a couple of rate decreases, 25 basis points per meeting, the first couple of meetings of 2026.
In some of the conversations I'm having here at the New Economy Forum, people are pointing to the uncertainty of who will take over from Jerome Powell. That might move the market, move the needle in a significant way. What are your thoughts on that?
Well, first of all, he's not out until May of 26, but Trump and his team could name a successor, frankly, any day now. I worry, because I like our current Fed chair's independence, that if brought to Congress for nomination for potential replacement of Powell next May, if you have someone who is perceived as just a Trump lackey, the market actually, I think, will take that poorly. And I think it could be a real risk.
Paul, what does it all mean then for the dollar, and how will that shape investment decisions?
So the interesting thing about Trump's policies is when they embarked on this, you would have expected the US dollar to rise and interest rates to fall. Unfortunately, the reverse has happened. And so in the near term, it can be a boon to US exporters, but over time, the facts that rates rose when they're expected to fall and the dollar weakened when it was supposed to strengthen actually bodes poorly.
Paul, thank you for joining us today. Great assessment there. Paul Meeks, Managing Director and Head of Technology Research at Freedom Capital Markets. Now, Federal Reserve Governor Lisa Cook says officials should keep a close watch for unexpected losses in private credit that may spread to the wider U.S. financial system. Cook flagged recent private business bankruptcies in the auto sector that ended up revealing wider exposure among banks, hedge funds, and others.
The likelihood of observing additional cases like those recently in the news increases when size of exposure and level of complexity in these arrangements are not transparent. When a sector experiences periods of rapid growth, and when these arrangements have not been through a full cycle, boom and bust of credit.
Joining me now, Rachel Lau, Managing Partner and CEO of Iris Capital Partners. Rachel, good to have you with us. We're back to being concerned about private credit. Your thoughts on whether we should be?
I think private credit is a segment of the markets that is underserved because SMEs, especially in Southeast Asia or Asia, hasn't been able to tap global funding the way that the major corporates and the banks have served in the U.S. So in Asia, we don't see that as a big concern, but that doesn't mean we're unique. But it just means that there's a differentiated asset class that will be okay in this part of the world for now.
But that could be ripple effects. It would see an explosion in the credit space in the U.S., for instance.
Yes, but I think any sort of liquidity event can cause that sort of ripple effect. It doesn't have to be credit. It could be just equity. In a couple of years, the last couple of years at the very least, we've seen credit being a good substitute of equity because the liquidity in the markets hasn't been as strong. That said, credit is now maybe just substituted by the public market sentiments, which means there's a lot of IPOs coming up and therefore a substitution of the credit space.
So no reason to be concerned in Asia, in Southeast Asia in particular. How about the concerns in the U.S. market? Are they justified? Are the cockroaches there and should be paid attention to?
So apparently, Jamie Dimon has now dialed back on the cockroach, at least on the GIC insights.
But he's not the only one.
Yes, I understand, but the private credit guys have also taken his lunch, right? And so there's also, there's liberal competition over there. But the reality of it is the banks have not been as competitive over the last couple of years from Basel II concerns. And I think that was probably the bigger issues for people getting their normal financing needs from a bank. So the private credit guys were not unique in a sense that they were new. It was just there was a space in the market that was underserved at this point.
Well, those are not the only concerns in the market. We're talking about the sell-off in the equity markets in particular. As you look to IPO your companies, how are you looking at the sell-off today?
All sell-offs, public markets are always about volatility, right? There need to be highs for people to make money, and there need to be lows for people to kind of enter the markets. For us, I think the long-term trajectory of the IPO markets, whether in the U.S. and Asia, seems to be good. And I think we're bullish on the fact that we're monetizing some of our assets in the next couple of years.
And it is a matter of where you'll be IPOing. Right? We've seen you list in Singapore, in the US, in Hong Kong. So what are some of the considerations?
So for us, I think it's a market fit. We listed one in NASDAQ 2 years ago. That was because it was a social commerce business and people like that business. We did one in Hong Kong. It's a Singapore biotech business. It's called Morex's. Today, Abbott just announced a purchase of Exact Science for $23 billion. Our business is now it's IPO'd in May. It's called Morex's, and it's only now $2 billion, right? So it's 10 times the valuation, and we believe and they do cancer research, and so we believe there's a lot of upside from that standpoint. We're listing one called Foodie in the KLSE right now, as we're talking about. It's the first Southeast Asia social media platform, KOL business. We're listing one in Singapore. So we've done 4 countries in the last 18 months, and that's very bullish. Again, I think to your point on which country, I think it really depends on the markets. All the businesses that we've IPO'd are tech businesses. So we do see an opportunity for tech to exit in this market right now, especially in Asia.
Tech in particular has been a very volatile space.
Correct.
Is the timing right?
When is the timing right? I think the last couple of years has taught us we should hit the iron when it's hot. When there's an opportunity, we should exit. We should be smart about recycling our capital, and I think we just have to stay true as fund managers. And if we do deploy and exit at the right time, we'll be okay.
Southeast Asian listings have had a dire time in the first 12 months of being listed.
Only in Singapore.
Why is that?
I think there's just, obviously there's a euphoria in the U.S. A lot of the money has been kept in the U.S., stayed in the U.S. The liquidity has not came over. I'm from Malaysia. We do see Malaysia being a bumpy year for listing, even for tech. We're doing one right now, and we see a huge oversubscription on the business. We're IPOing the foodie media business on 28, which is the Friday next week. And I think the markets are strong in separate or different pockets of the world. Each market obviously has its nuances.
Why not list in Hong Kong? That is the hot IPO market.
Well, Hong Kong has 300 listings in queue, and so if you want to list anything in the next at least 12 months, you'll need to wait. And so I think if you're doing, you got to be pragmatic on where your local businesses are. For this, it was a Malaysian business. For Morex's, they capitalized on Chapter 18A, and so it was really to fast-track biotech businesses in this region. I think Foreign Minister Vivian just said there's a biotech revolution coming our way. We're capitalizing on that, and again, capitalizing on what data we have in China and kind of making sure that we monetize some of this data.
Singapore, SGX, has been trying to revive its IPO market. And recently, of course, we had the SGX tying up with NASDAQ for dual listing. Is that a game changer?
It's a game changer if you're someone like Caro, for example. I think the reality of it is if you're able to trade 24 hours, that gives you ample liquidity in the markets. And that will be a game changer for someone who is big enough. There are a couple of businesses in Southeast Asia that is ripe for that exit. A lot of the funders have been there for 10 to 12 years. This will certainly be helpful to monetize the assets, but also create that liquidity and recycling the capital. And again, that creates a DPI that everyone is talking about in Southeast Asia right now.
It wasn't too long ago that we talked about how companies are staying private longer.
Yes.
How much has that changed?
I think it's changed dramatically over the last 2 years. If you were staying longer or private for longer, then I think you will have to answer to your LPs, which at this point, I don't think they're very patient in listening to the story at this point. And so I think you need to create exits. Again, the reason why Silicon Valley has done well over the years is because there's been exit and there's been recycling of capital. We haven't seen that much in Southeast Asia. We've got Grab and Gojek. Or slash Goto at this point. And I think besides that, there hasn't been many big IPOs. And so we need that IPO to return the capital to investors so that they can also put it back together into like the smaller businesses.
Rachel, thank you so much for joining us today. Rachel Lau, Managing Partner and CEO of Iris Capital Partners. Now, still come on Insight. Our live coverage from Bloomberg New Economy Forum continues with an exclusive interview with TCS President of Growth Markets, Girish Ramachandran. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insights. Just a quick look at where markets stand as we're tracking that sell-off across the region on renewed AI valuation concerns. Take a look where we are. It is red pretty much across the board. Take a look at CSI 300 index inching lower by about 2%, but it's really the Nikkei 225 and the Kospi which are leading the decline. In fact, the Kospi slumped more than 4%, currently just under that level, and Nikkei 225 down by more than 2%. Bear in mind as well, we've seen a massive rally in these benchmarks before. The concerns remain the same, valuations in AI, and whether or not those capex spending by those AI companies, tech companies, are justified. Now, Tata Consultancy Services has announced $1 billion investment from TPG to fast-track its expansion into AI data centers in India. As one of the leading global IT services and consulting companies, TCS is a key arm of one of India's largest conglomerate, Tata Group. Joining us exclusively, Girish Ramachandran, President of Growth Markets at Tata Consultancy Services. Good to have you with us, Girish. First off, that news, TPG pumping a lot of money. It's not the only American company, of course, that's pumping money into India for data centers and AI pretty much. We had the likes of Amazon. What's your take on what we're seeing right now?
All the geopolitical issues which is happening around the world is causing maybe countries to start relooking at nationalism, and there is a lot more nationalism coming in to play. And when you come into nationalism, then a lot more countries wants their data and sovereignty to be residing in their own country. So that is what is probably playing out, and we ourselves see that as an opportunity. So we recently announced a sovereign secure cloud for India. It was announced around 8 months back. And we look at sovereignty in a slightly different way, and that's probably what the way the government looks at it as well. The government sees that all the data in the country has to reside in the country. So if there is an outage around the world, the country will function. Okay. The second important thing that country looks at is whether all operational sovereignty can be maintained, which means that people who are maintaining the cloud or maintaining the applications physically live in the country. That's the second part which is happening. And the third one, which is probably a little bit far away, is looking at digital sovereignty, which means that can I build all the chips and can I build all the hardware in the country itself so that even we are not dependent on a third country to look at this. So when you look at all the three things together, that is where TCS is looking at a sovereign secure cloud. We are already sovereign in the first and second layer, which is on the data and the operational side. The digital layer is something that we are working on, and it will take a few years for us to get there.
Can India really live up to expectations? We heard from the Indian minister yesterday talking about India's own chip ambitions. It wants to be the T3, the top three basically, in I think 2034. What needs to happen for India to realize that dream? And what role do you see TCS playing?
As you are aware, we have a company called Tata Electronics, and who is on the forefront of this, of the chip ambition. And we have been working with them very closely on seeing how we are able to help them through this particular journey. We do believe that India can achieve its ambition as long as the entire supply chain works around it. We do have the biggest advantage that we have, Haslinda, is our talent base that we have in the country. If we are using the talent base to our advantage, and if the government is able to provide all the shops to build the infrastructure in the country, we genuinely believe there is a great opportunity for us to realize our dreams.
What might hinder that goal?
What could hinder is probably the whole supply chain issues. If you are unable to get the supply chain ready, that could be one problem. And the other issue would be the ecosystems. The ecosystems has to come in place. As you know, in a semiconductor industry, you need to have the entire ecosystem play, and all the entire ecosystem has to come in line.
We've been talking about how companies are spending trillions of dollars on CapEx to build those data centers and build the AI capabilities. I'm just wondering, with the sell-off we're seeing today, there's some doubt that those CapEx numbers are sustainable. What's your own take, and what are you hearing and seeing from your own customers?
If you look at India, I think India as a market has the potential, because India today has only 1 gigawatt of data center available. Okay. So India, if the growth trajectory continues, we will need by 2030 at least 10 gigawatts of data center availability. And that's why we have jumped into the bandwagon. And what we have said is, we as a company have said that we want to be the largest AI-led tech services company in the world. And instead of going on the broader side, we said we will pick the depth, and we will go whole hog on this. Okay? And that's why we said that we will create we will create applications and as well as services around AI, but we will also go to the depth and create data centers in India. And that is why you see the investment from TPG. We formed a joint venture with them, and we're putting $2 billion in that particular investment right now. And we have an opportunity to create a completely new data center in India, because India needs them for the moment. Okay? And Tata is definitely the most trusted brand in the country. So.
And we know that data centers need a lot of power. How do you secure that? So
we have Tata Power, as you know, in the ecosystem, and Tata Power will provide us with the necessary
power.
How
will it scale?
There is enough. I think there is. If you look at India's move towards renewables, there has been a significant push towards renewables in the last few years, and we genuinely believe that we have an opportunity to go the renewable route and mainly use renewables to power our data centers.
Girish, of course, you're taking charge of emerging markets. What will drive your growth in the next 12 to 24 months?
I do think that emerging markets has has gone through this upheavals in the last few years with tariffs and all of that through significant resilience. If you look at most emerging markets as doing very well. In fact, if you look at TCS's own trajectory in emerging markets, we have done phenomenally well in this space. So we are only optimistic that we have a significant role to play in these emerging markets, and we are present in those emerging markets, Linda, in a big way.
But which emerging markets are showing potential?
So, for example, I look after Asia Pacific, India, Middle East, Africa, and Latin America. I'm if you look at my own thing, I'm very happy about performance in certain markets. For example, Brazil is doing very well. Okay, in Latin America, Brazil, Mexico is doing very well. We recently opened our AI-led centers in both these markets. The Kingdom of Saudi Arabia is doing very well. UAE is doing very well. Similarly, South Africa, we think can flip and can turn around. India is obviously a big bet for us. We do genuinely believe that India can do very well. And in Asia Pacific, almost all the ASEAN countries as well as Australia is doing very well. So,
can you quantify what very well means, and can you quantify the kind of growth you're anticipating?
So we've been having double-digit growth even last year.
That's about what, 50%?
No. I mean, in India we grew 60%, over 60% last year. These markets offer tremendous opportunities, and the good thing is not many SIs are present in these markets. They don't believe that. They always look towards the West, whereas we've always been looking at the world holistically, and we believe that we can make a significant inroad into these markets.
Well, it is an uncertain environment right now with trade uncertainties. Of course, the US and India are still negotiating that trade deal. How much is that playing into decisions made by investors and companies?
So US is obviously a very large market. US is almost 50% of our market. So obviously there is a significant portion of play in that market. But if you look at the opportunity that exists for us, we have clearly called out that we are not heavily reliant on H-1Bs any longer. Our experience in Latin America has taught us how to become more and more localized in every market. And last year we hired almost 19,000 plus people in the US. So if required, we are even open to saying that we don't need anyone H-1Bs, and we can operate without H-1Bs. So that gives us...
At this point in time, you can operate without H-1B visas.
That's what we have openly called out as well, that we have enough talent in the country, and we see this as an opportunity to grow talent in the US as well. So we do genuinely believe that we have an opportunity to do that.
But it is about having the ecosystem. Some may argue that India still doesn't have that ecosystem to build the talent and also the industry the way that the US can. How are you looking at that?
You are talking about the hardware side, but in the services space, I mean, we are probably one of the largest talent provider for the whole world. Okay.
But you need both to coexist.
You need both to coexist, and so we have enough talent in the US who can work with the US ecosystem to build that in the country.
Still looking at the tension between the US and China, how do you think that might impact sentiment in terms of investments into India?
I think India can look at it as an opportunity, because there is a significant supply chain realignment going on, and India could start building this talent pipe. You see the number of GCCs coming into the country, as well as number of Western companies looking at India much more holistically. It was not that in the services world, China was never a huge competition for India in that way. But this gives us an impetus to start building talent much more holistically in the country.
You touched on the Middle East and how optimistic you are about that market. What are you seeing in terms of the trends emerging from the Middle East?
If you look at the transformation of some of these countries, like Saudi Arabia, for example, in the last 10 years has been phenomenal. We play a significant role with the government in Saudi. We are involved in most of the large programs in the kingdom. Similarly in UAE, and we do believe that what we build in India, which is the digital public infrastructure, is a significant opportunity for us to take it overseas and play in these markets. Okay. So almost 35% of the world's payment trade goes through our platforms, okay, retail payments. Okay. So I think there are opportunities, and most of the banks in the Middle East are our customers. So we have a significant opportunity to play not only in the banking space, but also in the public sector space as well. Yeah.
But it is in the AI space, data center space, that is most competitive, and it is no secret that Saudi Arabia, the likes of Saudi Arabia and the Middle East, want to play a critical role. They want to be the hub for it. When you take a look at the competition among the regions, who might win, and what does that depend on?
Look, there are two parts of the AI. One is to creating the physical infrastructure, which is what a lot of countries are today doing. Okay? Once you start building that, you need to start somebody to support in terms of talent. Okay? And these countries don't have the talent today to get to their ambition. And India has the largest amount of talent available today. So this is an opportunity for us to work closely with some of these countries to see how we are able to bring some of this talent to the country and help realize their own vision.
So how are you thinking and looking at your headcount in the next 12 to 24 months?
We do still believe that we will be a net headcount. We will still keep adding net headcount rather than reducing headcount.
Is there a number?
No, we are not looking at any numbers, but we do still believe that we continue to take talent from the domestic market, from all the domestic markets. In fact, even in Singapore, we recently achieved almost 70% localization. So we continue to use this opportunity to localize our workforce across these markets.
Girish, great to have you with us. Thank you so much for your insights today.
Thank you very much.
Girish Ramachandran, President of Growth Markets at Tata Consultancy Services. Now, coming up, we'll hear from one of the most consequential architects of recent U.S. economic security policy. That interview with former U.S. Secretary of Commerce Gina Raimondo is coming up next. Keep it here with us. This is Bloomberg. Welcome back to Insight. Former U.S. Commerce Secretary Gina Raimondo says the world needs to see more policy clarity and certainty from Washington. We spoke to her earlier about tariffs and the broader U.S. competition with China.
Is an even bigger problem than the tariff level. That being said, a triple-digit tariff is a problem. But you can't expect countries to continue to trust the United States or want to make big investments in the United States or trade with the United States if they think the tariff rate will change, 2 or 3 times a year. Your company can't plan for that. So I hope we're in a truce, to answer your question. I hope that it'll be sort of status quo, at least with China. But the quicker we can get to some certainty, the better we'll be. Now, mind you, I think the president has a fair point, which is to say other countries have taken advantage of our openness and American workers have been hurt. So addressing that issue is an important thing to do, but you need a strategy with clarity and some certainty.
And the message has to be clear. I wanted to ask you, too, what do you think the message is to some of, not just China, for example, countries like Japan, Korea, for example, where, if you think about it, in the end, they ended up with more uncertainty around their tariff conversation relationship with the United States. What message do you think needs to be polished, if it needs to be improved a little bit, or what message do you think the U.S. is sending to its trading partners?
I think it's the wrong message, because Japan and Korea, the 2 examples you gave, are some of our closest allies. And we want, I am of the view that the world is a safer place when America leads. A strong America that as a leader is good for the world. It provides, and if America withdraws, that vacuum is filled in a way that is less secure. And in order to lead, we need partners. In order to compete with China, we need partners. Korea, Japan, Europe, long-standing partners. Now, if you think that they're engaging in unfair trade practices, fine, address it. But treat your allies like allies. These are the countries and companies we want to have, to invest in the United States, for example. And so I think it's a mistake to to treat allies and adversaries in the same way, because we cannot compete with China without friends.
And there's been so much talk about where we are in terms of these chip curbs, which we've seen some delays from the Trump administration. Do you see that there's going to be a risk if the Trump administration eventually does allow for the shipments and sales of these Blackwell chips to China?
Look, the devil is in the details. I think the absolute most cutting-edge chips, which we have, which China doesn't have, is a completely different discussion than disallowing sales to China of chips that they already have, right? That just hurts American companies. I mean, I do agree that having the world run on U.S. AI rails is a good thing, right? I think it is a good thing to have diffusion of U.S. chips so that countries all over the world use U.S. models, U.S. data centers, U.S. hyperscalers, U.S. chips. So I think that's fine. The thing that I do quibble with is national security shouldn't be for sale. So if you say, as this administration has said, this chip can't be sold to China, and then you say it can be sold to China if we get a 15% of the revenue, that doesn't make sense to me, right?
It isn't that important.
National security is, you can't put a price on it. It's not for sale. So should these chips be sold? Maybe. Like I said, that's a detailed analysis. I think most chips should be sold because China has that capability already. And why deny U.S. companies revenue? But the thing I strongly disagree with is putting a price tag on the protection of the American people.
And that was former U.S. Secretary of Commerce Gina Raimondo speaking with my colleagues Yvonne Mann and David Inglis. Well, breaking news out of Japan. Japan set for 17.7 trillion yen in fresh spending via an extra budget. That amounts to about $112 billion, and that's according to the Cabinet Office. Those outlays would likely be funded via an extra budget, and they mark a 27% jump over what her predecessor rolled out just a year ago. Again, Japan set for a 17.7 trillion yen in fresh spending. Of course, it's something we've been waiting for. These are just the details that have already been announced earlier. Japan's economic package will be about 21.3 trillion yen overall. Now, back to the New Economy Forum, and for more on the issues discussed at the event, Bloomberg correspondent David Gura joins us now. Of course, we've been talking about reindustrialization of the U.S. It is a conversation you had with Gina Raimondo earlier. The question really is whether it is realistic or, the U.S. has already been left too far behind.
She talks about it in a very nuanced way, and indeed she did when she was in the administration, the Biden administration. She thinks that we should be targeting certain sectors where it's important for the U.S. to have independence. So she just wrote a very big report for the Council on Foreign Relations about biotechnology, for instance. She thinks it should be something that's very finely tailored. And the conversation that we had was also with the governor of Oklahoma, who's a Republican, who really wants that state to be one of the biggest states for business in the United States. The door is wide open, he says. He'll take whoever wants to come in, and he's recently inked contracts with an ammunitions manufacturer from Brazil, an aluminum company from the UAE. Just fascinating to hear sort of what they think the future of manufacturing looks like. You bring up something very important, which is the U.S. has found itself so behind the curve here that the hill that they have to climb to get manufacturing in the U.S. is very tall. And the governor admitted, labor is a huge weight on any company that wants to bring manufacturing to the U.S. There are, of course, a lot of workers in the U.S., but there are not a lot of manufacturing workers. How do you develop the infrastructure, the apparatus to train people to do those jobs? And I think what was so interesting about the conversation was, is that something that should be incumbent on the government to do? Does there need to be kind of a national workforce strategy in place? That's something that Secretary Raimondo has advocated for. Or is it best left to businesses, to companies themselves? And Governor Stitt of Oklahoma thinks that the private sector can do a great role here. If you're going to build a big factory, you know what kind of workers you need. You can invest in that workforce. So kind of a fascinating look at sort of that debate, which is still very much roiling in the U.S. right now.
Gina Raimondo identified certain sectors, but when it comes to the Trump administration, they talk about just making manufacturing great again. But when you take a look at the supply chains today already, they've moved. And you've got to question the benefits of making manufacturing great again in the U.S.
So let me take those in kind. And the first is we have this phrase, make manufacturing great again, and it's very vague. I think that everybody would kind of admit that. It sounds very good on paper, and the governor said during the course of our conversation, look, he can quibble with the tariffs policy or the trade policy, but no governor, no one in any elected office is going to say it's not a good idea to bring more jobs to the U.S. But you're right, the supply chains have moved. We've seen them move in recent months as a result of President Trump's trade policies. And the notions of kind of nearshoring and friendshoring have changed as well. I mean, there's the old saying, with friends like you who need friends. And so you had the U.S. who worked so closely with Mexico and with Canada. Canada, of course, smarting a lot, wondering sort of what's happened here with that relationship with a very close ally. So it's happening in that very close arrangement, that nearshoring relationship. But as you say, we've seen China change its tack. We've seen all of these countries up and down that supply chain looking for new geographic domiciles in which to do this manufacturing. And the U.S. is sort of not in that conversation in a very real way. Sort of they're watching that all unfold, but they're not really a part of it.
It's about infrastructure, it's about skills, both of which are not really present. And it's also the appetite of the American workers, whether or not they want jobs in such sectors.
Absolutely. So we're at a point in the U.S. where the labor market is showing some signs of fissures, of cracks, and maybe that'll be a catalyst that will get more people kind of interested in these service sectors. A huge question, though, is what are these jobs going to be fundamentally? Again, there's a lot of nostalgia surrounding this. We're going to get these factory jobs, but of course, as you know, manufacturing is very different now. It's high tech, it's smart. How do you train people for those jobs? And right, are there people going to want to take those jobs on? In the U.S., if you're upwardly mobile, you want to go to a four-year college and you want to get into the service sector. How do you kind of change the way that people in the U.S. think about their job prospects? It's just a huge question here, and one I think that this administration and others are going to have to wrestle with.
So reindustrialization, how realistic is it for the U.S.?
It's happening. And so you have a governor like the governor of Oklahoma really looking at incentives packages to get companies to move there. Again, I think that the president, by saying he wants to bring manufacturing back, has opened the door to people treating that with new seriousness. But I think still very much undetermined is what does that renaissance look like? What does that manufacturing renaissance look like? And again, there are so many fascinating things about being here at this conference, but I think it opens one's eyes to the way that manufacturing works around the world. And what if that is replicatable in the U.S., what isn't, and how do companies kind of pursue that if they want to in the U.S.?
And what's really key to that?
A huge thing is just investment. And I think we haven't talked a lot about uncertainty as well. And so another panelist, Sarah Williamson, who spoke to Bloomberg TV earlier, kind of works with companies, executives and investors on thinking about the long term. Very difficult to do that in the context of reindustrialization. If you have trade policies that are inchoate and constantly moving, what's the tariffs level this week? What's it going to be next week? You know, building a factory is a very long-term investment. It's not like moving capital around. You have to build the building, you have to find the workers or train the workers. And I think that there are a lot of companies very reluctant to engage wholly in this process right now because they don't know how it's going to turn out.
David Gura, great to have you on the show. Thank you so much for that perspective. David Gura, Bloomberg correspondent and host of The Big Take. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. Asian markets slumping today on renewed concerns about an AI bubble after a brief rally driven by NVIDIA's earnings beat quickly evaporated. Stocks benchmarks in Korea and Japan are on track for their worst weekly drops in months. Bitcoin, meantime, touching $87,000 with investors in firm risk-off mode. Also weighing on markets is the uncertainty over the Fed's ability to cut rates in December after the delayed September jobs report showed more hiring than expected. Well, for more on the market sentiment, let's bring in Morningstar Director of Active Research, Lorraine Tan. Lorraine, how did we go from a rally to a sell-off overnight?
Hi, morning. Well, I just think that means that people are still taking money off the table. People are sitting on decent profits and probably towards your end and probably having a look at how they want to start 2026. We don't actually share the same extent of concerns over the AI bubble, so we actually think the pullback is healthy and brings more opportunities for the market to move up in the new year.
I'm just wondering if it's other concerns driving the markets lower. It could be the Fed, questions about whether or not it will cut in December, and perhaps even the replacement of Jerome Powell. Are there other concerns apart from just that AI bubble?
Yeah, so if you look, obviously one of the things is that market valuations are, a little bit higher this year. So we don't have the same sort of level of buffer that we had a year ago. Particularly in Asia, I would say. So because of that, You once you've got some negative news, you're going to see that sell off. So we are a little bit priced to perfection. But having said that, that's why I think this pullback is healthy. The Fed, obviously, interest rates where they're headed is key to sentiment as well. We do think that with the U.S. economy expected to slow, that we will get the Fed cutting in the new year, if not in December. Basically, the other concern is that global growth is slowing, but I think that should be partly factored in as well.
You said you're not too concerned. It's just, some of the froth taking off, being taken off. I'm just wondering, what signs are you looking out for to perhaps start worrying if this correction could be a meltdown?
Yeah, so one of the things that, one of our views is obviously on the AI side that we actually don't expect a lot of the so-called, expansion, all the excess data centers, et cetera, to actually get off the ground. Because obviously a lot of funding now is a bit concerned about where the returns are coming from. So we may not actually get that bubble as a result of the current worries. So that's probably works in the favor of the longevity of the cycle. The other things that we watch out for, obviously, we're a little bit disappointed with the slowdown in China still, that just pertains mainly to the China side. And we do want to see more or stronger policies to support consumption from the government, which has been slow. Geopolitics is always there, although I think the markets are a little bit less sensitized to Trump's statements at the moment. But a flare-up of some tariff hookup between China and U.S. again could trigger another round of selling.
You talked about how it is a buying opportunity. What would you be buying?
Yeah, so things are come down, to more attractive levels. Even in the States, even though there could be a little bit more room for things to pull back, NVIDIA, for example, is back to a buy call on our side. Within Asia, we see TSMC as a proxy to the growth in the space. The Asian names that are more tied to AI are probably still a little bit expensive. On the China side, the large cap, good quality companies like Tencent, Alibaba, we still have buy calls on. Consumption has been lagging, obviously. So for those people with a longer term time horizon, these stocks are still attractive.
Of course, when you take a look at the biggest losers today, it is actually the Kospi. It's down more than 4%. I'm just wondering what you see opportunities in Korea.
Yeah, so the Korean market's always fascinating because it is mainly driven by where Samsung Electronics is headed. So obviously Samsung's had a very good run up. We actually have our analyst has a sell call on it, underperformed. So we're not surprised that, things need to be taken off the froth a little bit there. In terms of where else we do like over the longer term, the story in Japan still, or any company that is actually focused on improving capital allocation, having shareholder return targets. So we do like the spate of share buybacks and increased dividends that we've been seeing for some of the Japanese names in particular.
You said earlier you're pretty disappointed with the environment in China. Growth remains lackluster. But when you take a look at valuations, especially in the AI space, they remain pretty attractive for a lot of international investors. How are you looking at the potential there?
Well, I'm not sure how attractive it is, particularly among, let's say, the bigger swath of companies in China on the AI side. The discounts that we're seeing in China are still very much concentrated on the consumer sectors. That's understandable because it's been disappointing there in terms of the recovery. Multi, for example, is a quality name, still not much growth. It's been lagging in share price performance, for example. In terms of the AI, where all that is headed, we like Alibaba. We think it's a very multi stock. It is able to play off its network assets to build on its AI activities, cloud activities as well. So specific to that in China, still monetization is a concern. Valuation for some of the chip companies still very high. Overall, probably just still Alibaba, Tencent, the core names there. TSMC on the large cap side on the broader longer term chip outlook as well.
Bloomberg ran a scoop just yesterday talking about how the Chinese economy could get new stimulus in the property sector in particular. Would that be a game changer? What are you looking out for? Is it in terms of numbers, the extent, the depth of that stimulus package?
Yeah, so I think, the China real estate side, I'm a little bit skeptical about how much of the stimulus is going to be. It's still, it's still sort of feeling the pebbles. It's been piecemeal in that sense. Probably if we can get a rock move, that would be good. But excess inventory, I would say, for the property side is still a concern. We actually don't see, we're seeing better price support among well-located assets in tier 1, tier 2 cities. That we think as the pricing downdraft sort of eases, that may bring back some confidence for people to buy. But really, a lot of excess inventory still needs to be absorbed. So if there's a policy to help the local governments make that move on a faster pace, we maybe use that stock to create subsidized housing like an HDB system, I think we would see that as positive.
Lorraine, as we inch closer to the year end, number one, are you anticipating a center rally? Is that still possible given what we're seeing today? And two, how would you position for 2026? What themes are you looking out for?
Yeah, so it's interesting because I think the market has been a little bit excited over perhaps some of the anti-involution activity. So some of the stocks like the solar side, the EV side, the share prices have moved up. So we're actually not finding as many opportunities there. The pricing recovery could be a little bit slower, but so we're keeping an eye out for that. So for the new year, we're still looking at where the value is. So we're still going to be focused on some of the consumer names in China. In Japan, which I mentioned, we like the coal capital allocation story. I think the rising interest rates there still gives support to the financials. Some of the banks, we still like Itochu on the trading house side. So fairly wide swath of, there's more varied opportunities, I would say, in Japan market, let's say, whereas the pure undervaluation in China, the largest gap to fair value on our estimates is still within the consumer space.
What is the most underappreciated opportunity, you think?
Oh, there are quite, with the pullback recently, I think for people who are looking for growth ideas, there's opportunities there. So there's names like Tencent Music that has come off a bit. There's on the consumer side with Yum China, for example, that's been, basically re-rated down for quite some time. And I think those opportunities will start to come through with the stimulus. I think those are potential drivers. Those are two themes. One is the pullback, that will, recovery on those growth stocks. The second thing is, the stimulus story that we should hopefully drive China consumption.
Lorraine, thank you so much for that. Lorraine Tan, Morningstar Director of Equity Research. Now, another ongoing risk for markets has been President Trump's tariff and trade policy. When Trump rolled out global tariffs in April, economists braced for the worst, including higher inflation. But so far, the price hikes that were forecast have yet to materialize. Bloomberg Originals investigates why, and here's a preview.
Credit where credit's due, President Trump made a big bet that the US had a magnetic appeal, and that would enable him to get a better deal from US trade partners and companies that want to do business in the United States. On the evidence of the last few months, that bet is playing out pretty nicely. Economists don't agree on much. One thing they do agree on is that free trade is good and that tariffs are bad. For a moment, Trump escalated US tariffs on China all the way to 125%. If you plugged the US tariffs into a model of the global economy, what it said was that there was going to be a really significant drag on growth And there was also going to be a significant upward impulse to prices. But when we look at what's happened to inflation over the summer, it's not come down, but it's not come up either. Why is that? It's because US importers and foreign exporters saw the Trump tariffs coming, and they rushed to front load, shipping to the United States before the tariffs could come into force. One thing that's happened is that we've gone from a lot of unexpected bad news concentrated on a single day to a series of country-by-country deals. They're something of a Swiss cheese of exemptions and carve-outs. The trade war is a drag, but it's not the only thing which is happening. We've got tax cuts with Trump's one big beautiful bill, and we've got a bonfire of regulations which is stoking the animal spirits of US businesses. We've also got the artificial intelligence boom and a huge amount of investment going into data centers. Tariffs are having an effect. China's exports to the United States are way down relative to the historical trend. So, who pays for the cost of tariffs? Despite his well-known love of gold, the president is not an alchemist. He can't make something from nothing. That money has to come from somewhere. All of the evidence so far suggests that in the end, the bulk of it is going to come from US businesses and US households.
Subscribers can watch the full documentary on the terminal and Bloomberg.com. It will also be available on Bloomberg Originals' YouTube channel later. Now, still to come, OpenAI partners up with Foxconn to design AI data center hardware. We're live from Taiwan next. Keep it here with us. This is Bloomberg. We're tracking moves across Asia's major chip makers. What a reversal of fortune. Despite NVIDIA's better-than-expected performance, TSMC under a lot of pressure, currently down, along with Hon Hai down by almost 4.5%, and SK Hynix in particular being dumped currently, down by almost 8%. The sector as a whole, the infotech sector, lower by 4% as we speak. Now, staying with AI, OpenAI is partnering with Hon Hai, also known as Foxconn, to design and manufacture hardware for data centers. For more details, our Asia Tech correspondent Annabelle Julius joins us from Hon Hai Tech Day in Taipei. Belle, what more do we know about this deal?
We are very much supporting society.
Yeah, well, it really has been one of the biggest announcements so far. So yes, Hon Hai Tech Day is underway here in Taipei. Today we've got one of Hon Hai or Foxconn's EV partners on the stage right now. We can get more on those EV ambitions in just a moment. But yes, as you said, that big announcement has been OpenAI and Foxconn announcing that they're going to be working together on hardware infrastructure for AI data centers. But it's not the first time, actually, these companies have worked together, because they're very, very intimately involved in Project Stargate in the US. Foxconn is the biggest supplier of AI server racks to Oracle. Oracle, OpenAI, SoftBank are working on Project Stargate together. So yes, there is that connection, but this is the first time we've seen Foxconn directly working with OpenAI. And we actually had an address earlier from the OpenAI CEO, that's Sam Altman, of course, speaking at Hon Hai Tech Day. Take a listen.
To keep pushing the frontier, we need to build these new types of AI infrastructure hardware at scale. And I'm excited for that to happen in the US and with Foxconn. Foxconn's experience building complex infrastructure and hardware at massive scale makes them the ideal partner for this, and I'm looking forward to exploring together what this can look like. We'll share insight into emerging hardware needs across the AI industry, and Foxconn will use that to design and prototype new equipment that can be manufactured in America.
We know market, we know customer.
So you just heard there some more details. Essentially, Foxconn, OpenAI working directly together on co-designing and developing data center server racks. So I think Sam Altman, what he said at the end is particularly important because he referenced that this is going to be built in America, and that is a huge feat because AI server racks maybe sound simple, but they're incredibly complex. They've got more than 5,000 cables in each, so to produce that cabling, the power systems, other key equipment, that is going to be a big challenge for Foxconn moving forward, even though, just to note as well, this agreement doesn't have any specific purchase.
Its battery ambitions are in focus. Tell us more about that, Belle.
And then expand the market.
Yeah, exactly. So batteries, I mean, as I said, we've got the EV demonstration going on right now, and this is a really big bet of Chairman Yang Liu. His view essentially is that just what happened with the PCs at the end of the 1990s, where they started to move to that outsourcing model, his view is that exactly the same thing is going to happen in the EV space, and that inflection point around outsourcing, he says, is going to happen in the near-term future. So the company is fast preparing to be able to produce more and more components. Batteries are key for that. Batteries are also going to be key for other parts of the business that Foxconn is trying to work on and develop higher value, higher margin industries as well. But I did visit Foxconn's new battery facility in Kaohsiung, met with the man as well who's leading this effort. Take a listen. Foxconn's best known for assembling Apple iPhones and now is a major producer of AI servers. But here in the city of Kaohsiung in southern Taiwan, a different bet of Chairman Yang Liu is taking shape. His goal is to transform the tech giant from traditional manufacturer into a leader in new, higher margin activities. EVs, digital health and robotics are at the core, all of which require power packs, which Foxconn wants to mass produce. Troy Wu heads up a team tasked with achieving that goal.
In the future, we believe the scale of the battery will not smaller than the semiconductor itself.
But the company faces a tough path ahead, even with production of EV cells already underway. First is materials, with many Foxconn suppliers relying upon China, which has been flexing its grip over rare earths. Then there's competition, not just from across the Taiwan Strait, but also battery heavyweights in Japan and Korea, plus building out distribution channels. So far, Foxconn has just 3 buys for its vehicle product, though it's planning to increase output in 2026. Still, that's not a deterrent for the company, which sees a big opportunity in AI in particular. It already counts hyperscalers like Amazon, Microsoft and Alphabet among its biggest customers, plus Nvidia. Now Foxconn's working on energy storage cells that could become key to managing the huge power demands of AI servers.
For the long-term consideration, a stable power supply for the AI data center is very important for AI data center operation. So battery can play a very, very important role.
There are links to other parts of Foxconn's business.
Currently, Foxconn already take around 40% server market, manufacturing market. Their customer, they always request the better, the safer battery technology and the better efficiency server battery technology for servers. So we now currently we work with our BG or subsidiaries who work with the server client.
Foxconn's chairman is optimistic about the business heading into next year and says AI will be the biggest driver. It's too early for batteries to contribute any meaningful revenue, but they are part of the long-term vision. So I think batteries, of course, we're continuing to see those becoming more and more important in AI in particular, and especially energy storage systems. So it's very apt, I think, that you've got this announcement today going back to OpenAI and also Foxconn together working on this AI data center infrastructure, because again, batteries are going to be a big important element of that.
Belle, all that buzz, and you can see that huge screen behind you. You'll be speaking with Foxconn's chairman later today.
Yeah, that's right. We're really excited about this interview coming up. So this is Young Yu, who's back on the stage again just to wrap up this event. He's already been really going through his bold ambitions that he has. As I said, it's about moving beyond just being seen as a traditional manufacturer into more higher value activities. But as we said, AI has certainly been at the centre of that. And in our conversation, we're going to get more details on his concerns possibly around circular deals, valuations as well. But there's a lot more coming up, so that conversation in another couple of hours.
And we're looking. Another Bloomberg Asia tech correspondent, Annabelle Drulis, thank you so much for that. Of course, we're looking forward to that conversation. It is a market sell-off here in Asia, extending the declines we saw overnight. Let's take a look at how those benchmarks are faring. We know that the Kospi has been leading the pack lower, down by more than 4% earlier. The Kospi currently right where we expected it to be, lower at that range. The MSCI Asia Pac Index being dragged down by all the benchmarks in Asia, down by 1.7%. The concern remains the AI valuations, also the capex. And of course, we had that NVIDIA numbers better than expected, not enough to sustain the rally we've seen for such a very long time. In terms of U.S. futures, let's see how they're shaping up. Lots of expectations that there are other concerns that might also weigh on the benchmarks, but futures pointing to a slightly higher open. S&P futures currently up by 0.3% after that massive sell-off overnight. Perhaps it is not quite surprising, and we've been hearing about buying the dips. In terms of U.S. Treasuries, this is how it's looking. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Here's a quick look at where markets are right now. It is pretty much red across the board. The Nikkei 225, the Topix, the Kospi, all in negative territory. The Kospi in particular dragging Asia lower, down about 4% right now. It is that AI story being dragged down here in Asia, extending the losses we saw overnight. AI valuations in particular. And when it comes to trade and tariffs, one sector in particular that's grappling with the fallout from President Trump's repeated shifts in policies, as well as decreased funding for research, is pharmaceuticals and biosciences. Mammoth Bioscience focuses on gene editing therapies to address needs in the medical space. Let's bring in co-founder and CEO Trevor Martin. Trevor, good to have you with us. We've been talking about AI and that sell-off in the markets. How widely used is AI in your space?
Yeah, I think it's very widely used. I think a lot of the focus, though, is on what we call preclinical work. So that's developing new drugs. I think it's really cool, really exciting. But I think a lot of the impact will actually be on the clinical side. So how do you actually run clinical trials faster? How do you get more drugs actually into market, into hospitals, into people, and improving their lives?
It is about transformation, right? When you talk about AI, people talk about how AI will transform. How will AI transform your research, the area that you're involved in?
Well, I think that's why AI and bio is so exciting, is that it's not another chatbot, right? It's actually something where we can generate something physical, something that improves people's health, using technologies like AI. So I think one of the under-talked about ways that that's going to happen is that if you're running a clinical trial, you're spending 7 years, $800+ million, and that's something where there's tons of paperwork, there's tons of things that LLMs are already good at, that these generative models are already good at. So can we apply those to clinical trials to make those much faster, much more efficient, and hopefully at the end of the day result in more drugs that help people?
What will they be able to do in the future that they can't do right now? What are we underestimating?
Yeah, I think we're underestimating a couple of things. I think, first of all, the number of drugs that we could actually run through clinical trials. And I think that's important because, especially with now generative models from AI, like what we use at Mammoth Biosciences to generate new types of CRISPR technologies, I think being able to take even more of those and kind of putting them through that clinical trial pipeline will inevitably result in more drugs that help people and save lives.
You talk about clinical trials. Are you anticipating that perhaps Asia could be the space for it?
So I think that's an interesting point, because if you looked a couple years ago, I think it's something like 25% of clinical trials were in China. If you look today, I think it's something like 50%. I think if current trends continue a couple years from now, it'll probably be 75, 80% plus. And that's both a challenge and an opportunity, let's say, for countries like the United States, because I think we really are ceding a lot of that biotech ground to other countries, and China in particular. And I think that's something where we're kind of sleepwalking into it. I think this happened in other fields like semiconductors, energy, and now we're trying to claw it back in different ways. And I think that's an area where there really does have to be some real thinking about how do we think about clinical trials in the US? How do we think about research funding for biotech in the US if we want to reverse that trend? Because if things just stay on their current trajectories, China's going to be the biotech leader, not the US.
But what does China have that the US doesn't right now that's allowing it to grow at that pace? Pretty aggressive.
I think it's a combination of things. I think, first of all, it's a more permissive regulatory environment. And that doesn't mean we have to replicate that in the US. Maybe it's too permissive, but it exists. Second, I think it's a massive amount of funding for certain deep tech sectors. That's kind of a risk benefit of governments like China, is that they can back up the dump truck of cash in sectors that are important to them. And biotech's important. I don't think we've really made the decision on that in the US yet. I think it should be important. I think that we should be building lots and lots of medicines that save lives in the United States at every part of the spectrum. And then third, the US's superpower was that the smartest people on earth come to the United States, they get educated there, they stay there, they found companies. We still are the leader in that, by far. But I think that's something that we take for granted, and we really, really, really should focus on how to make sure that people who are the best students from around the world stay in the United States, because I can tell you that's the most frustrating thing to every country on earth, is that they want to found companies in the US, and how to make that as easy as possible.
The problem is the Trump administration is actually putting a lid on the talent from overseas, and also in terms of student presence in the universities. Might that play against the US? How might that impact the industry?
I think that's where you have to think carefully about these policies, because if we really are putting America first and we're trying to make America the country that has the forefront of AI research, biotech research, semiconductor research, that's going to be coming from people all over the world. And how do we make them want to come here, want to stay here, want to bring their families here? I think that's something that really would benefit from us being very focused on. And I think it's something that will really make America continue to be the kind of beacon on the hill for the rest of the planet.
You pointed to the permissive environment in China. What's the downside to that? What have you seen that could be of concern to you?
So clinical trials are always a risk-reward benefit. On one end of the spectrum, you can approve nothing, and then, of course, you'll never have a drug that has any sort of risk. And on the other hand, you could not have any sort of regulatory environment, and then you'd have snake oil and just people dying from various diseases. So I think that the job of regulatory agencies is to really find the societal balance between those. And I think that historically, we've done a very good job in the United States of making sure that we're approving very safe and effective drugs. And for biotech companies like Mammoth, that's actually a deal. Like, we want there to be strong regulators, because that's how you prevent snake oil and drugs that are going to harm people from coming into the market, because it's very expensive and time consuming to build a drug. So you want there to really be a bar of saying this has to be safe and efficacious to actually get approval. Now, that being said, how do we make sure that good drugs don't get stuck in the process, and that you can actually, at reasonable costs, do those initial tests, and if something's safe, see if it's efficacious as well? And I think there's a lot of creative ideas that people have for how to do that. And I think there's a really interesting opportunity in the current moment of time that I think is being grasped even today on how do we implement certain versions of that, so that maybe we don't have the Chinese system, but we can kind of tune the US system so it has an even better risk benefit to it.
Genetic diseases, you're pretty optimistic that they can be cured within 10 years. Why is that?
Yeah, I think we're rapidly approaching the point where we're going to have the technology stack so that for a given genetic disease, we actually have a path on how we could cure it, which is an amazing statement. I think the task before us becomes A, making sure we actually execute on that over the next 10 years, and B, what order do we work on all these diseases in? Like, how do we prioritize them? Even for one company like Mammoth to do hundreds of drugs, that's a tall order, let alone multiple companies doing thousands of drugs. How do we think about, like, what are the diseases that should come first in that priority stack? And then also, we have to think about, this is a new model of healthcare. How do we want to pay for this? This is something where with CRISPR and what we're building at Mammoth, it's a one-time permanent cure. So you literally go into the doctor's office, you get a single injection, and then the promise of the technology is that for the rest of your life, you're truly cured of that disease. So that's a very different way of thinking about the healthcare system in general. So we have to think about how the healthcare system will look in a world that has these types of.
All right, so what breakthroughs, what milestones, what timelines should we be looking at?
Yeah, so I think what's really exciting is that already today for the CRISPR technology, there's an approved therapy in the US for sickle cell disease. So it's a very sci-fi concept, but it already exists. And I think what's exciting is you're seeing a lot of what we call liver-based diseases that are having clinical trials for genetic cures, and I think many of those will be successful. And then one of the areas that we're especially pioneering at Mammoth is how do you then move beyond blood and liver and go to muscle and brain? When you think of genetic disease, you probably think of like Alzheimer's and Parkinson's and Huntington's. How do we deliver on the promise of genetic medicine? And fundamentally what drives us at Mammoth is this idea of your genetics should not be your destiny. Like you should not have to play the cards that you're dealt at birth. And I think that's an amazing world that we can actually live in within our lifetime.
Now, you talked about Trevor, thank you so much for that. We have to live with Trevor Martin, co-founder and CEO at Mammoth Biosciences. Now, we're also tracking the Japanese market today as Japanese Prime Minister Sanae Takaichi's cabinet has approved the largest round of extra spending since the pandemic to address voters' frustrations. Let's get the details from our economy and government reporter, Erica Yokoyama. Erica, why is this package this big in size?
Yeah, as you just said, the package is going to be 21.9 trillion yen in total spending, and of that, the 17.7 trillion yen is coming from the fresh spending, which is most likely the extra budget. That is as to Takaichi's reputation of her pro-stimulus policy. The package ended expansive because it partly reflects her fiscal policy, but she also needed to incorporate some ideas and requests from the opposition parties, as well as the Liberal Democratic Party's new coalition partner, Ishin. And, due to the bigger extra budget, now the governments will likely need to issue additional bond, and that could be probably bigger than the last year. And, it's already fueling some market concerns about public finances, and you can see on yields as well. On 5 and 10 years, JGB yields climbed to the highest level since 2007 earlier this week.
Erica, what are included in the package?
Sure, the package actually covers a wide range of measures from short-term aimed one and also some longer-term ones. And the biggest portion goes to the price relief, totaling 11.7 trillion. That includes winter utility subsidies, cash handout for households with children, and several tax cuts as well. And the government estimates that these measures altogether can lower the Japan's price gauge, overall CPI price gauges by about 0.7 percentage point for several months in 2026. And, other things in the package include that the measures some funds to ensure the implementations of the $550 billion of US, Japan, and the investment project, as well as some investment support for key sectors, including like shipbuilding, quantum technologies, or critical minerals.
And of course, Erica, it's all happening against a very weakening currency. I'm just wondering, what's the perspective from the government? Is it caring? Is there a sense that it could possibly intervene?
It's a really good question, Haslinda. So amid all the development, along with the speculation about possible delay in the BOJ's rate hike and the Fed rate cut, the yen is weakened quite rapidly in recent days. The currency is currently trading at the weakest since January and sliding towards the 160 yen per dollar. That is the level when the Japanese government stepped into the market last time in July 2024. This morning, actually, Finance Minister Satsuki Katayama lumped up her FX warnings, saying that the governments will take appropriate action if the FX moves looks and pretty volatile and excessive. And she also said FX intervention remain one option. And this morning we had the CPI figures that's suggesting that Japan's national key inflation gauge has stayed over the BOJ's 2% target for 43 months, marking the longest streak since 1992. So I'm pretty sure the authorities are pretty alert to the currency level as the yen may continue to accelerate the inflation again.
Bloomberg's Erica Yokoyama in Tokyo. Thank you so much for that. Now, still coming inside, our exclusive interview with TCS President of Growth Markets, Girish Ramachandran, after the firm announced $1 billion investment from TPG to fast-track its expansion into AI data centers in India. Keep it here with us. This is Bloomberg. Welcome back to Insight. Tata Consultancy Services has announced $1 billion investment from TPG to fast-track its expansion into AI data centers in India. Earlier, I spoke with its president of Growth Markets, Girish Ramachandran, about the investment and how geopolitics factor in.
All the geopolitical issues which is happening around the world is causing maybe countries to start relooking at nationalism. And there is a lot more nationalism coming in to play. And when you come into nationalism, then a lot more countries want their data and sovereignty to be residing in their own country. So that is what is probably playing out. And we ourselves see that as an opportunity. So we recently announced a sovereign secure cloud for India. It was announced around 8 months back. And we look at sovereignty in a slightly different way, and that's probably the way the government looks at it as well. The government sees that all the data in the country has to reside in the country. So if there is an outage around the world, the country will function. Okay? The second important thing that country looks at is whether all operational sovereignty can be maintained, which means that people who are maintaining the cloud or maintaining the applications physically live in the country. That's the second part which is happening. And the third one, which is probably a little bit far away, is looking at digital sovereignty, which means that can I build all the chips and can I build all the hardware in the country itself so that even we are not dependent on a third country to look at this. So when you look at all the three things together, that is where TCS is looking at the sovereign secure cloud. We are already sovereign in the first and second layer, which is in the data and the operational side. The digital layer is something that we are working on, and it will take a few years for us to get there.
Can India really live up to expectations? We heard from the Indian minister yesterday talking about India's own chip ambitions. It wants to be the T3, the top three basically, in, I think, 2034. What needs to happen for India to realize that dream? And what role do you see TCS playing?
As you are aware, we have a company called Tata Electronics, and who is on the forefront of this, of the chip ambition. And we have been working with them very closely on seeing how we are able to help them through this particular journey. We do believe that India can achieve its ambition as long as the entire supply chain works around it. We do have the biggest advantage that we have, Haslinda, is our talent base that we have in the country. If we are using the talent base to our advantage, and if the government is able to provide all the shops to build the infrastructure in the country, we genuinely believe there is a great opportunity for us to realize our dreams.
What might hinder that goal?
What could hinder is probably the whole supply chain issues. If you are unable to get the supply chain ready, that could be one problem. And the other issue would be the ecosystems. The ecosystems has to come in place. As you know, in a semiconductor industry, you need to have the entire ecosystem play, and all the entire ecosystem has to come in line.
We've been talking about how companies are spending trillions of dollars on CapEx to build those data centers and build the AI capabilities. I'm just wondering, with the sell-off we're seeing today, there's some doubt that those CapEx numbers are sustainable. What's your own take, and what are you hearing and seeing from your own customers?
If you look at India, I think India as a market has the potential, because India today has only 1 gigawatt of data center available. Okay, so India, if the growth trajectory continues, we will need by 2030 at least 10 gigawatts of data center availability, and that's why we have jumped into the bandwagon. And what we have said is, we as a company have said that we want to be the largest AI-led tech services company in the world. And instead of going on the broader side, we said we will pick the depth and we will go whole hog on this. Okay? That's why we said that we will create we will create applications and as well as services around AI, but we will also go to the depth and create data centers in India. And that is why you see the investment from TPG. We formed a joint venture with them. And we're putting $2 billion in that particular investment right now. And we have an opportunity to create a completely new data center in India, because India needs them for the moment. Okay.
President of Growth Markets at Tata Consultancy Services, Girish Ramachandran. Now, even as we're seeing markets slump and fresh worries about a potential AI bubble, Muddy Waters Capital CEO and short seller Cousin Block says now is not the time to bet against the biggest U.S. tech names.
If you're out there trying to short NVIDIA or any of these big tech names, you're not going to be in business very long. So when I look at AI, you have all these AI adjacent companies, you have these AI player or AI pretenders. That's where you would want to look to short. However, so long as the leaders such as NVIDIA are still going up and to the right, I think that would be a very dangerous trade.
For more on the outlook for AI, let's bring in tech columnist Pami Olsen, who joins me here at the Bloomberg New Economy Forum. You know, Pami, you've had a lot of conversations. That's been a key theme here at the New Economy Forum. What are some of the key takeaways?
Well, I'd say broadly, there's a lot of optimism still, in spite of everybody talking about the fear of an AI bubble, and of course, stocks and the NASDAQ declined just overnight. And that did come under discussion and people did address it. But by and large, there's a general sense of optimism that this is still a technology that's going to be transformative and one that can make money. I was just speaking to former British Prime Minister Rishi Sunak yesterday. He's a huge advocate for AI. A couple years ago, he was all about AI safety. Now he's about AI diffusion, and that's how governments can be successful, is if they somehow help their populaces to overcome their fears of AI, and they can adopt it and benefit, get an advantage from AI, even if, say, Europe or the UK doesn't build those AI models if they're coming out of Silicon Valley. Businesses here are saying, look, we've seen this with tech revolutions in the past. There's hype, then there's a kind of trough of disillusionment, and then eventually people start to face the practical realities. And again, perhaps the final point that people are saying here is businesses just take time to integrate a new technology. And it was like that with the PC. It was like that with the internet. These things take years. You're a big company with systems and processes. And AI, it's only been 3 years since ChatGPT came out. You know, in 9 days, it's going to be the 3-year anniversary. And so I think there's a sense of, look, we're still in this experimental stage. But part of me wonders if people here are a little bit in their own bubble of optimism as well, because I think people like Michael Burry of Big Short fame make a great point that even though NVIDIA has just come out with better than expected earnings, this is all part of a kind of consolidation of interests of big tech companies who are making money just from sort of selling and doing deals with each other. And the real question is, who are the end customers and where's all that revenue going to come from, not just from the infrastructure players?
Some people also talk about the proximity paradox. Yeah. You know, ironically, those people who are closer to AI are the ones who are most afraid of losing their jobs. But the conversations around here are also about how, you know what, maybe you won't be losing the jobs. I remember a survey being done, and that's the least of their concerns when it comes to the people attending this conference. Square that for us.
Well, I think businesses especially, the big concern for them is security and their data security. And I was just talking to an AI company here on the sidelines, and they were saying they have big arguments with a client about the API access and just how strong it is, and whether they are, the data security is, they cannot compromise that an inch. And so that's an issue for the employers. And then, of course, for the employees, they're being told, look, you've got to use this. It's going to augment your work. It's going to make you more productive. And of course, there's that fear that if I can accelerate the output with AI, could it eventually displace me? And so one of the kind of points being made here by people like Rishi Sunak is we've got to address those fears. Otherwise, people won't take advantage of AI as well as they should, which I think is a fair point. But I think there probably isn't big enough to address the issue of those end revenues. Like, where is that end revenue going to come from?
It's also about the AI war. Who will win it, the US or China?
Yeah.
How are they weighing on that issue?
Well, that was so interesting. I was on a panel just about an hour ago with Anna Fang from Zhen Fund. They back a lot of startups in China, like Manus, who are one of the competitors to DeepSeek. And she was saying, it's so funny that in Silicon Valley, they talk all about this AI race between China and the US. Actually, startup founders in China don't care. They're not talking about a race between China and the US. They're very ambitious, they're very globally minded, much more so than the previous generations of founders that built Alibaba and Baidu and ByteDance. This new generation, they're under 25, and they want to build big companies and have a huge impact. I think that is still very much top of mind for officials and company leaders in China, but certainly for the startups, they don't seem to care.
Pami, great having that conversation with you. And in the end, whether it's open or closed, that's the other thing that needs to be looked at.
Yes.
Bloomberg tech columnist Pami Olsen there. And that is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.